This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I have an interesting show today. 2 guests, back to back. First, Frank Curzio from Stansberry and Associates. Frank has been on my show before. We always have these debates on Facebook, Frank and I do. And I wanted to have him on to give the fundamental perspective, and a little pushback from me, of course, but the fundamental perspective about why markets are okay, why stock markets are okay at all-time highs. After Frank, back to back, I have Robin Griffiths. He is Chief Technical Strategist at ECU. Previously, same position at HSBC for 20 years. Robin comes at it from a technical perspective. And Robin is not exactly believing in the all-time high equity market situation. A nice, long, deep interview from 2 very compelling personalities, each giving their own version of food for thought. And of course, me thrown into the mixing bowl just for shits and giggles. I hope you enjoy. 2 fun guests. Here's where I want to go, and maybe this is the cross uses this content. So, we were debating on Facebook a little, and I kind of threw it out there, and I knew it was a little bit aggressive posture. But with equities at essentially all-time highs, I said, how can the fundamental guys justify these all-time highs with fundamentals? Like I mean, it's easy from a trend guy perspective. Heck, I don't know why it's at all-time highs. Just follow along.
But
how do the fundamental guys at these all-time highs, and I've got some notes here that I'll bring up with you and you can kind of address them, but how do the fundamental guys say that, hey, things aren't wildly overdone? Let me give you one to chew on. You can start with this one and then you can expand into other ones. So the one that I was looking at, which is the most famous one, is Shiller's CAPE ratio, right? And so today it's roughly 26, 27. There's only been 3 instances where it's been higher, 29, 2000, and 2007. Now, of course, and he'll say this, that doesn't necessarily mean markets can't go a lot higher. He's just saying empirically, here's where we're at based on this particular ratio that he's famous for. So how do the fundamental guys, I mean, isn't that a true fundamental that a fundamental guy would be saying, hey, hold on, we're at all-time highs and the CAPE's at this, and what do we do now?
Well, this is what I suggest that all your listeners should do, and it's pretty cool. When you get to that page for the K-Shiller ratio, print it out, take it, and throw it in the garbage because it's useless. And I don't say that because I'm a big fan of Shiller, but I'm going to give you some more facts. You're right. It's trading at 26 times using the Shiller PE, and we could say, wow, it's traded that time. But let's throw some more facts in there. The Shiller PE has only traded below 20 twice in 22 years, okay? So, and one of those times it was like 19.5. So you're looking at an index that basically told you the market was expensive for the past 22 years. And if you listened to it, you avoided it, and stocks are at all-time highs. And if you bought stocks 22 years ago, you're probably sitting nicely on a beach. It's the worst measure. I don't know why people use this. If you're a bear, you use this stat. I understand it. You're a bear because it makes it look like it's more inflated. It's an inflation-adjusted index when we have no inflation. If you take, it just makes absolutely no sense to me. But if we let's take the traditional PE ratio, which everybody has been using for the past 50, 60 years since the S&P 500 became 500 companies. Right now, we're trading at 17 times earnings. Now, if you're looking at that and you look past environments where, we talked about bubble, like say in 2000, and the NASDAQ was trading at 40 times earnings, we're trading at 17. In 1987, stocks are trading around 21 times earnings. And you say, wow, that's close, pretty close to 17 times. So maybe we're almost there. And again, it was 20 times that September right before the crash, but interest rates were in the double digits. And it's very important. You have to analyze interest rates. You can't just take a simple PE or even the K-Shiller if you're a bear and that's what you like to use. Again, I think it's useless because you never would have been in stocks for the past 22 years by using that. But if you're using the traditional S&P 500 and you're looking at interest rates, in 1987, interest rates were at double digits. You had alternatives. A-rated bonds were yielding 10%. If you look at the environment, we had $400 billion in loans to undeveloped nations, not emerging markets, undeveloped nations, which was a ton of money, $400 billion back then, which was money that was going to be lost. So we set up in 1987 with super high interest rates, and yeah, it was a bubble. But when you have low interest rates, and it's a low interest rate environment, and guys, listen to this, it's going to be low interest rate environment for a very, very long time. If you're looking at interest rates in the past, if you pull up a 50-year chart of the Fed funds rate, it's been below 2% like in 3 periods. It's very rare. I think it was below 2% in the 60s, 1960s, 2002, 2003. It was below 2%, and today's environment is 2008. So it's very rare. But to get that up to 3-4%, we're never going to get back up to 3-4%. Not never, but not in the next 5 years. I just can't see it happening. As long as we have a low interest rate environment.
Let me flip this on you, Frank. So now that the S&P is at 2,000 roughly, and based on what you're telling me right now, that's cheap.
I'm not saying it's cheap. I'm saying it's not. I'm saying it's not expensive. There's a big difference. I didn't say it's cheap. You said it's cheap. I said it's not expensive. But I'm going to tell you something. It's trading at the same exact level as it was since January 2013, 17 times earnings. And you know what? How many people I know have said that the market's expensive at 17 times earnings, and so you should avoid it. It was trading at the same levels in January 2013. We're up 30% since then. We're still trading at 17 times earnings because the earnings is going higher. Earnings are moving the fastest, the biggest that they moved in the last 7 years. So they're moving at double-digit rates. That's very important, Michael, now to your audience. So you're looking at a market that's trading at the same level, yes, 30% higher, and that's why we're coming down, because we're seeing slower growth across every place else outside the U.S. That's a major risk. And you're seeing it out of Ford come out and say, listen, we're having problems in Europe now. And again, Russia is the biggest trading partner in Europe and accounts for a huge percentage of GDP for some of those countries.
Isn't everyone going to have trouble if the dollar is banging out new highs? I mean, everyone outside the U.S. is going to be like, this sucks, right?
Everyone outside the U.S., but yet you're going to see huge inflows into the U.S., right? Because where are you investing? I mean, you have to put that capital someplace, right? You just can't put it in cash because you're going to lose money after inflation. Where are you going to put it? Every other country is going to put in the U.S. because it's the strongest place right now. So it's just interesting. I'm not saying that stocks are cheap. I'm just saying I think this bull market is going to continue as long as we have low interest rates, as long as we don't see an absolute crash in every emerging market and developed nation, which is possible. We're seeing that right now, and that's why we see the market coming down. But for people to say that this market is expensive are the same people that said the market is expensive because it was trading at the same levels in January 2013, and we're up 30%.
Let me give you a lifeline really quick. So, I want you to make the case, though, for how high stocks can go. Once again, this conversation is meant to just be different than what I typically do. I want to hear the fundamental perspective. So I would love for you to make the case as to how high stocks can go. Where does the point in time happen to where you, Frank Curzio, start to say, my God, I'm really nervous about tail risk right now? I mean, can stocks double from here as long as rates stay at zero and you're still kind of like, okay, it's going to be okay as long as rates are at zero? Isn't there an uncle point from a fundamental perspective?
From a fundamentals perspective, it absolutely is. And I don't, you can't put a number. Obviously, you can't predict the future, how high the market's going to go. But right now, I'm in the markets. I love this pullback. I'm adding to my personal positions. I'm telling my subscribers to as well. We've been in this bull market for a long time. But one of the things I would say is if the fundamentals change where we're seeing drastically slower growth, we're starting to see that. Okay. If we see 5% growth out of China, if we see Europe go into another recession, okay, we're going to see it's going to hurt the market. So we have to monitor that. If we monitor that, then I'm going to take money off. So I don't know how high it can go, but I know if we stabilize or if we see growth in emerging markets, if we see growth in developed nations like Japan, if we see Europe come out of this okay, if we don't put those huge sanctions on Russia, which is going to kill Europe, which we're finally starting to learn based on what Ford said, who has hundreds of suppliers of small cap companies who are going to get impacted if Ford does bad. And that's why the U.S. market does bad just when, Russia announces that, they can't trade with their partners in Europe anymore. But if you're looking at that from a fundamental point of view, then I get worried. So, am I worried a little bit right now? I'm concerned. I still see interest rates low. low. I don't see Europe really going into a deep recession right now. So I'm long the markets as long as interest rates are low, and that's going to be the policy for a very long time. But again, if we see
why does the Mac Daddy of American Wall Street success stories, the guy out there in Omaha, why is he sitting on $55 billion in cash? Why doesn't he put that stuff into the market right now?
He is. He just announced the other day he's buying companies. I mean, he just bought another one. What was it? It was in a rail service.
Yeah, but he's still got $50 billion on the sidelines. That's a lot of money.
But isn't that a bullish sign because you have that much money on the sidelines? I mean, I'm in the hedge fund community. I talk to these people. I'm fortunate enough to have these contacts after 20 years. They're dying for Disney to come down 20%. They're dying for Exxon, IBM, Apple to come down 20%, which means that, wow, if they come down 20%, you're going to see the Buffetts of the world and everybody else put a ton of money into this market, which almost puts a floor under it.
But why do they not put it in now? I'm just playing the devil's advocate, fundamental devil's advocate. Why is Buffett sitting on $50 billion now? If this market is something that is worthy of, there's still room to go, rates are at zero. Why does Buffett sit on that cash hoard right now?
I can't speak for him, but I know he just bought one of the largest car retail chains recently, right? I mean, this is the other day. So he's seeing values in the market. 3 years ago, he bought a railroad.
I would have to say that what percentage of that $50 billion was the car dealer? I mean, I'm being facetious, but I'm serious. I see that when I see that.
It was about $8 billion. So it was about $8 billion, I think. So it's an $8 billion retail business. I'm not too sure how much he paid for it. I know it's a private company, but it was an $8 billion business. So, I mean, he's looking for things to buy. But again, we're talking about someone else and what they're doing with their money. I can name you 50 hedge fund managers that have been on the sidelines since 2009. I mean, I don't know what other people do with their money. I know I've been in this market and fortunate enough, we've done well, and I've been wrong at times. I'm not, patting myself on the back saying, wow, what I see in this market is a Fed that won't let the market go down, which I hate. I think if this market comes down 30%, what do you think the Fed's going to do if it comes down 30%? Again, I don't agree with this, but the last time the market crashed 35%, right? What did the Fed do? They gave vouchers to buy cars and houses. They bailed out all the banks. Look at Fannie and Freddie. They're like the two largest institutions in the world right now. They thought they would be zombie banks. They're printing out billions and billions of dollars in money. The hedge funds are arguing you should let these guys go. And they're like, well, we don't know what to do with them. So what do you think, Michael, that the Fed's going to do if we come down 30%? Not whether it's right or wrong, but you really think they're going to sit on their hands?
No, I think you make a fair point there. I mean, I think everyone has to consider. The question becomes, will they be able to do the same trick again to make the same thing happen again? I don't know that answer, but I agree with you that since they have had the results that they've had with the zero interest rate policy and QE policy, you have to think they would go back to that arsenal again.
And people say they ran out of bullets, and I mean, they could have a QE3, QE4. They have a printing press. They never run out of bullets. Remember, they gave us vouchers to buy cars and homes, which is insane. But the fact that, they bailed out every bank, and look where the banks are today. According to the Fed, they got it exactly right. They're not looking at our deficit because we have low interest rates and we don't have to worry about paying that. And we're not going to have to worry about paying that for the next 5 years because we're going to have low rates. But again, as an investor who's telling their clients or someone who recommends advice, you're putting a floor under this market when you have a lot of hedge funds with all this cash, and even you brought it up saying, wow, I hope this market comes down 10, 15% so I could buy these great names. And then you have a Fed, if it goes down 30%, saying, basically, look, it worked last time. Look at the banks. You had Citigroup, Bank of America and JP Morgan pay $37 billion in fines. What was it, a month ago, 2 months ago? And when they got fined, they took it out of their back pocket and said, here you go. That's how much cash these banks have in their balance sheets.
I think also I want to interject a point here, and I think this is your perspective. You're not necessarily saying that these types of policies that we think might be there to set a floor if there was a 30 or 40% drop. You're not saying, hey, Michael, I think this is the greatest thing since sliced bread. You're just saying, reality-wise, trying to be objective, this is what I think. I think they would go back and repeat, wash, rinse, repeat. They would do it all over again because they had the results they've had so far, and they would go right back in there. You're not saying you, Frank Curzio, think this is a grand idea for...
Absolutely not.
But you're being objective and saying that's what would probably happen based on your perspective.
Exactly. And you hit the nail on the head. And a lot of people say, well, if you go on CNBC and you see Santelli, like he's just crazy about the Fed should never do this. I mean, you could be one of those guys that argues and yells, or you could be one of those guys that say, listen, this is what the Fed's probably going to do. And since they're going to do it, this is the way I'm positioning my portfolio. And I'd rather be that as someone who gives advice, who has their own podcast, just like you, and tell people, look, are we at bubble territories? No, we're not at bubble territory. Not at 17 times earnings with trillions of dollars on these companies' balance sheets, and earnings are growing 10%. And again, we're not cheap. We're definitely not cheap, but we're not bubble either. And that's what I'm trying to explain to investors. As long as we have a low interest rate environment, it is going to be a pretty good environment for stocks. Could I be wrong? Absolutely.
I have some people on my show right now that are surely thinking, Mike, you and Frank coming at this from different perspectives. But I did see you speak last year in Singapore in person. And I thought one of the interesting things you did, because I had not seen you speak before, is you said, here's my ideas. Here's what I think can happen. Here are some bets that I think are worthy of making. And I'm paraphrasing. But then you ultimately did come out and say during that conversation to an audience, you said, look, but you better have a stop because I don't know. And that's where I'd like to go right now in this conversation is we don't know. I mean, we're saying you're saying it could go higher, but I assume you are talking to people on your show and talking to people in person. You're talking about, I think it can go up, but from a risk management standpoint, you've got to be telling people also, likewise, be prepared if this thing starts to fall out of bed.
Exactly. And that's a great point. And I even had one listener, and I think he was also a subscriber, say, Frank, I think we're in the 8th inning of this, and I think we're going to have a collapse like we had in 2008, 2009. So I'm in the market right now. And I said, look, if you really believe we're going to have a collapse like 2008, 2009, where we had a credit crisis where every bank almost shut down, I was like, take your money out and put it under your bed. That's your choice. If you want to do that, if that's really how you feel, I don't feel that way. So, in terms of protecting yourself, you have to have, like, I probably have 45% of cash on the sideline just picking away because there's so many overreactions, especially in the small cap market, on bad news, because there's so many people out there saying the market's going to crash 40%, and they'll miss a quarter and they'll come down 30% on news that the stock should not be down 30% on, maybe it should be down 5% on it. And if you have money on the sidelines, again, bear market should be your friend. So if you're prepared. So you have stops on your stocks, and we've been in our stocks for a very long time where we're stopping out of a lot of positions because small caps have come down, but we're stopping out for gains because we've been in this so early. So we're protecting our gains. That's what I'm doing for my portfolios. And also when you have that cash on the side, like a Buffett who's just, just sitting there praying that this market comes down. He's like, I love when markets come down because I can buy more stuff. So as an individual investor, have cash on the sidelines. You probably have a lot of winners. Again, markets are still near their highs, even after this little correction in large caps. Have money on the sidelines. This way you can buy your favorite names that come down and place those stops in. This way you don't get stopped out and you're not losing all those gains you accumulated over the last 3-4 years.
Now, Frank, I've wrote some other names down of guys, well-known names that are very bearish, but generally not the kind of, I don't know, we'll see how you feel about these names. For example, I've seen the headlines that Soros has put options against the S&P. I have no idea the size of his position. Obviously, a guy like Sam Zell is not happy about the current market situation. Jeremy Grantham of GMO, not happy. Seth Klarman, I've seen say the Goldilocks economy, low volatility, relentlessly low interest rates. Are these guys just talking their book? Are they being good Americans to say there's something really wrong here? Or are we back to the original point, which is like that you keep making, which is like, hey, maybe these guys are all right, but if the market's going up, who cares if they're right? But then again, that's a trend following viewpoint, not a fundamental viewpoint, which is the beginning of my conversation. I have a hard time seeing where the fundamentals justify this going up, where there's so many fundamental guys are seemingly on the sidelines or are very bearish.
It is interesting, and I have respect for all those people that you mentioned there. And, in all due respect to the markets, they've all had those positions over the past 2 years, and the markets are up incredibly. So they've been on the wrong side of the trade. What they're not telling you is they hedge themselves, and they're not down as much as you would think. They have incredible trading departments, and they hedge themselves a lot. So they had not, even though the market's been up probably 30-40% since those guys have really been bearish. And again, I follow all those guys, and it's been at least 2 years, probably 3-4 years, a lot of those guys, especially the Dents, the Shillers, which I have a little bit more problem with them because like I said, we're all wrong from time to time, and it's perfectly fine to be wrong. But those guys have been wrong for a long time and have made a ton of money for themselves through books and stuff like that. And then sometimes I have a problem with that. You know, with the guys that you mentioned are all great fundamental guys. But you have to remember, we're in unprecedented times, so it's very difficult to analyze these markets. And when you're looking, for me, the biggest wild card is the Fed keeping interest rates low on purpose, right? I mean, they're basically manipulating this market to say, okay, interest rates are going to be low. We're going to have easy money for a very, very long time. They targeted the unemployment rate as one of the things they look for before tightening rates. And you know what? The unemployment rate came down so much, under 6% now. They're like, we're not going to use that anymore. You know, we're not going to use that. We're just going to use the inflation target of 2%. And if you look at the inflation target at 2%, they don't expect inflation to go above 2% until 2017.
I think you're a modified trend follower. You basically have said rates are going to be at zero for the rest of my life. And if that's the case, I'm going to be long equities. That's what I think I'm hearing.
It's kind of like that. But again, there's other variables in there. Because people who listen to me, I've been in this market for 20 years. I'm not a perma bull or a perma bear. I've been bearish for a very long time at certain periods. Or right now, I just don't feel that stocks are wildly expensive where you could find a lot of good names trading at 12, 13, 14 times earnings. Even Apple is considered a little cheap compared to how much they're growing, which is trading less than the S&P 500. You're looking for retirees dying for yield right now. What are they going to do? Well, they want to buy the McDonald's and the consumer staples, even though McDonald's is a name that, you know, isn't as secular. There's secular changes going on. People grow up, they're not taking their kids to McDonald's anymore because they know how unhealthy it is. And people are like, well, McDonald's pays a 3% yield, so I'm still going to buy the stock. That's how crazy it is. There's a lot of really good names that pay 2-3% yield out there. And it's much better than putting your money in the bank. And as long as you have no alternatives, remember, we're talking about institutional money, billions and almost trillions of dollars. When you're looking at alternatives and you can't really buy bonds right here because you got to be a little crazy and you'll get fired because the whole world thinks bonds are going to crash, even though it's been the wrong side of the trade. But if you buy bonds here as a hedge fund manager and you lose money, you're going to get crushed. Okay. You'll get sued because everybody thinks it's going to crash and the 30-year bubble's over. What else are you going to buy? Real estate at this level, you kind of have to tie up your monies and real estate has come back. You can't put it in cash. You can't put it in treasuries. You're going to lose money after inflation. So people are looking for yields and you have that growth component in stocks. So I think that's where I am right now. I really think the market's going to do a lot better than people believe because there's no alternatives compared to other times when there was bubble markets. There was alternatives to take your money out and throw them in double-digit bonds in 87. Right now, you don't have that opportunity.
Let me slide this in. So we kind of, and I'm paraphrasing a little, you might have said this exactly, I'm not sure, but let's say the Fed with this ZIRP policy, this zero interest rate policy, they're essentially pushing people in, as you just mentioned, they're pushing people into equities that would otherwise own bonds for yield. And they're saying, we're not going to give you any more yield, no more interest income, buy stocks. That's the deal that's been handed to them. Given that scenario, and I agree with you in the sense that, gosh, if rates are at zero, I mean, what's the government going to do? They're just going to keep us long equities. But I saw Julian Robertson of Tiger make the point, and he said, the 87 crash, from his perspective, came out of nowhere, And so what I'm curious about is the tail risk aspect of this whole conversation. That if everybody is just geared into long equities from a fundamental perspective, based on, hey, this is what we think the Fed is going to do. Isn't the tail risk, isn't that just increasing by some magnitude that we can't necessarily understand? When everybody believes fundamentally that this is the trade, this is our only option, isn't that one of the times? Isn't that maybe one of the reasons why Buffett's got so much cash on the sideline? Why Soros has these puts? Why Zell, Grantham, Klarman, why they're negative? I mean, beyond just their book, what about the tail risk, Frank? I mean, that's got to scare you a little bit.
Of course it scares me. Of course it does. But it's funny because you said if everybody believes that trade's on, they want yield. But you know what? Not everyone's not on that side of the trade. You just listed 7 guys that are short. You just listed Buffett, who's not. How many times have we turned on the TV and CNBC and there's another guy predicting a 40% crash? I will go back to the 87 crash because I've been very fortunate. My late dad, he was a money manager for 30 years. He got famous because he predicted the 1987 market crash. The only person who did it in writing in his newsletter. He titled the word crash in September. And I went back to read his newsletter not too long ago to compare that market to this market. And again, we had like a basement office, a very small operation back then. And we had 20 news vans outside this Queens office. And people thought we were getting busted for dealing drugs. It was so funny. And then he was on CNBC like every day after that. And there's so many people that claim that they made the 87 market call. I haven't seen anyone who's done it in writing. Okay, everybody said, just like, everybody had that money. Everybody predicted the credit crisis. Same thing. Back then, nobody really saw that 87 crash. And right now, everybody does see a crash. I mean, that's what we're talking about right now. You're talking about, tail risks. You're talking about all those people. You talk about Soros and everybody, Grantham. There's so many people that are on that trade that makes me think from a trend perspective, or if you're looking at a sentiment perspective, that there's a lot of people that are predicting a 30-40% decline. I'll put on CNBC, I guarantee in the next 2 hours, I'll see someone saying, listen, you got to take all your money out of the stocks. So I don't know. I may disagree to say that everyone's on that trade saying, hey, we all need yield. I still think there's a lot of money in cash and people are scared to own stocks. People are still in the bond market and haven't gone into stocks. But am I nervous? Yeah, of course I'm nervous. And again, I'm protecting myself through stops, and I do have cash on the sidelines. I'm not an all-out bull in this market. I'm just saying that fundamentals suggest we could go higher as long as interest rates are lower. But I'm not saying, hey, this is one of the best markets to invest in all time. I'm not saying that either. So, I just think right now the bubble argument should be off the table.
Okay, so let me get concrete with some numbers for a second. So we're at roughly 2,000 on the S&P. If the S&P goes to 2,500, what's your thought process or action? If the S&P goes to 1,500, what's your process or action that you take?
It's just a number. It depends. It depends on the fundamentals. What caused it to go to 1,500? I mean, like I explained, I use the analogy where we're trading at 17 times earnings. Everyone said it's a bubble. It's crazy. Got to be out of the market. And we were trading at 17 times earnings in January 2013. If earnings continue to grow at a double-digit pace, and then we gradually move higher in the S&P 500 over the next couple of years to 2,500 or whatever. Say if we have like a 10% gain in the S&P 500 over the next 2-3 years, and earnings, and it's because of earnings, it's because of strong balance sheets, it's because these companies are finding a way to generate earnings, and Europe has turned around. We don't have the sanctions in Russia that's hurting Europe, which in turn are hurting U.S. companies. If we see that fundamental landscape change, then it's different. I mean, you have to see what's warranted. If we go down to 1,500 and stocks, you still see earnings growth. Say if it's, God forbid, if it's a terrorist attack and everybody takes their money in the market and the S&P declines 25%, like we saw with September 11th, it turned out to be a fantastic buying opportunity because the fundamentals didn't really change. It was more of a fear event where, oh, wow, let me take my money out of the market. Who knows? I mean, people thought planes were going to start falling out of the sky. It was such a crazy event. So it all depends on the reasoning behind it trading at 1,500, the reasoning behind it trading 2,500. I would be buying, if we're still at 17 times earnings at 2,500, I would tell you that the market's going to go higher still. If we're at 25 times earnings, I say, guys, you got to take money off the table right now. If earnings didn't drive the market higher, if that makes sense.
Is your biggest driver, though, on your thesis, your fundamental thesis, and once again, for my audience that knows that I've written some books about trend following, but I wanted to have this kind of, not really debate, but I wanted to kind of get these other thoughts out there for comparison. ZERP. I mean, is your thesis is revolving around the Fed?
Three things, not just the Fed. It's interest rates keeping low as the Fed, earnings.
But the earnings are coming from the Fed. Ultimately, that action, that activity, the zero interest rate policy is allowing the increased earnings, no?
For some companies, yeah, it's providing easy money. It's providing more money on their balance sheets, which they could buy back stock, which is artificially inflating earnings. But yeah, I would definitely say that, yeah.
So, I mean, is that's ultimately, if I really had to kind of go through everything that we're talking about, the fact that the Fed has taken these actions, and you as a relatively young man, you say, my gosh, I don't necessarily like these actions. These are not,
I hate them.
These are not actions that might, there could be a day, there could be a day of reckoning, but you're saying to yourself, I'd rather be along for the trend before the day of reckoning comes, so I capture that profit on the upside. God, you sound like a trend follower, Frank.
I'm telling you, but that's the thing. And that's why when you posted that thing about fundamentals, it's almost like me posting something on trend following where I want to use everything I can to come up with the right decision. I mean, that's what we all want to do. I mean, because if one system worked, we'd all use that system and we'd all be millionaires. There's not one particular system that always works for everybody. So you want to incorporate some of the things that are working. And what's working right now is low interest rates that the Fed is providing. You're seeing companies able to turn that around and generate double-digit earnings, which we haven't seen in 7 years. And right now we continue to see that. If we see a slowdown in earnings, yeah, I would be worried. And that's what you're seeing in small caps right now that are getting impacted because you're seeing a little bit of slower earnings growth. in the sector that I cover, and small caps have come down 10% compared to the S&P and the Dow, which are down like 1-2%. So, there is a concern out there. There is a worry out there, and I am worried. But right now, with the fundamentals in place and a low interest rate system, I just, I've been in this market for the past 4 years telling people to buy in every single pullback. And I think we're going to get the same opportunity where you're going to see companies come down 10-15%. I'm seeing companies come down 20% plus in the small cap market, individual companies, not the whole Russell 2000. And it's just providing really great opportunities for my subscribers right now. That's what I'm focusing on, as long as we have a low interest rate environment and we continue to see earnings growth.
Does the length of this bull market concern you from a fundamental perspective?
Not at all. I mean, that's the thing that's kind of funny, because people look at it and say, stocks have been going up for 5 straight years, so they must come down. Guys, I mean, it's so short-sighted. You have to look at the fundamentals, I believe, just to say. And so if we've gone up and earnings have gone up, say if we've gone up for 10 years in a row, stocks have gone up, and earnings have been going up 30% annually, you really think because the market's gone up for 6 straight years that it has to stop going up? And that's why I try to bring in that analogy where, the fact that we're trading at 17 times earnings in January 2013, we're still fundamentally at that same level because earnings are growing. So you can look at it and say, wow, it's been 3 years, it's been 4 years. I've just seen so many people out of this market looking at this because of fears, and it's the wrong type of fears. I mean, fear that earnings growth is going to slow. That's a big concern. Fear of Russia. That's a huge concern. There's other concerns out there. Maybe Ebola, the outbreak is for real, which right now I don't think it is. That could be a huge risk, but focus on those risks, because the Fed risk and, oh my God, our deficits are out of control. I've heard that argument for 4 years and people have been on the sidelines, and I feel terrible because you're not looking at earnings growth, and the market has done really well over that time frame.
Well, Frank, I think the audience has some chewing to do on everything you've given them. They have to go out and make some comparisons and decide. I mean, you make a case. You make a fundamental case for why things can go higher. I think ultimately, though, you need some type of mechanism that gets you out. And like I said, I mentioned you and stop losses, because there has to be some mechanism that gets you out. Things don't go up. Things don't go up forever. There's got to be an exit strategy at some point in time. How do you generally, we're talking big picture here, and we're not talking specific stocks, and we're just talking broad equity markets going up. How do you generally talk to people about the exit strategy, though, given that none of us can truly predict the future? What's the exit strategy that you talk to people about?
Well, we never want to take a big loss on any one position. So we usually place a 25% stop. The stocks I recommend in my newsletter are small cap base, and I have a 2-year thesis. So I'll come up with a stock and say, these are the catalysts that are going to happen next 2 years. We want to hold it. However, if the stock comes down 25%, let's get out, limit your losses, and that's the best thing. And I love stop losses. You know why? Because selling is so much harder than buying a stock. And when you're selling, and the worst thing is, and I can tell you this because unfortunately I'm speaking from experience, but when you have a loser in your portfolio, all you do is focus on that loser. So in a bear market, you have a stock down 60, 70%. You're like, what do I do? What's going on? You're analyzing the news. If you stop out of it, you take the emotion out of it. And now instead of focusing on the stock that's down 70%, the whole entire market's down, and now you have cash and you're looking at stocks that are really good stocks that you want to buy. So that's what we try to do in my newsletter. I think selling's really hard. I've had trouble selling. I like putting these stop losses, and sometimes you'll get triggered and the stock goes higher. But I mean, again, nothing is flawless. There's no flawless system out there. This seems to work best for us, where we limit our losses and let our winners ride.
Well, let me talk about the more serious subject again, the zombie apocalypse with Ebola. So what are you doing to prevent in your neighborhood, to protect you and your family from the zombie apocalypse of Ebola? What are you doing specifically? Are you wearing a plastic suit? What do you do? Have you shaved your head? What do you do now? Your head was already shaved last time.
Yesterday, I really did the best thing to protect ourselves.
You shoot weird kids that are walking unusually on the sidewalk in front of your house? You just take them out? What do you do?
Exactly. Listen, it was very important I did this, but I took my daughter and my wife to the Jacksonville Jaguar game against the Pittsburgh Steelers. I thought we would be the safest there, and we watched the game the whole time and had fun. So that's what I'm doing about the Ebola virus, where I think, could it be a concern? Absolutely. Like, I shouldn't be joking about it. But remember, we have news services that are 24 hours, and there's not enough news to cover a 24-hour news service. So you're going to see the littlest thing. You're going to see thing at Ferguson blow up as much as they can and write stories as much as they can. I'm so glad we have social media. If we didn't, I think this would be a minor story, but you have everybody worried about it, which I think is a good thing. And usually the worst case scenarios is when no one's worried about it, the black swan events, even the credit crisis. No one knew what a credit default swap was until the market crashed 35%, that they were, had subprime loans and stuff like that. So I think the fact that everybody's on this, we have so many doctors chiming in, is a really good thing. I just think it's a little too much right now. It's something I'm not worried about, but definitely something you have to monitor.
By the way, without naming any names, one of the people that you were debating on my Facebook about Ebola was my crazy sister.
And so, you know what? Because Facebook is cool and you want to post strong things because that's when you get like hundreds of people. So I try to do that. And sometimes, like even you came over and said, Frank, you don't hate me, do you? I said, no. In your Facebook post, if you just post like mild things or nice things, people really don't respond. But when you really have like a strong opinion about something, that's when you get the 100 responses, which is pretty cool. So
I know how to make you come over really fast. I mean, I can literally just wake up in the morning and just know that I can make you post. I know the triggers. I don't even know you that well, but I know the Frank Curzio triggers that I can get a reaction.
Oh, it's great. Yeah, no, it's all good for like people. And some people even respond. They're like, wow, you really don't like my Covel? I'm like, no, we're pretty good friends, actually. It's just so funny. But, I have so much respect for you doing the books that you've written and trend following. And I'm so glad you actually chose to do a podcast, man. I know we talked about this and I know it's doing great and the guests you have on there are fantastic. So it's really cool to see you do. I mean, it's addicting. It's fun. And
it is fun. I mean, Frank, where can we send everybody?
Listen, I'm probably going to get a lot of emails. If you want to send them to me, fcurzio, stansberryresearch.com. You could also send them to my podcast if you want. There's one thing I always say, which is really cool, and it works out to have a great audience of great friends. If you disagree with anything I said, you can feel free to call me an idiot if it's a stress reliever, but tell me why, because I've had people provide me some really great research and actually change my mind and say, Frank, this is something you got to be, and everybody gets educated, and I come out and read those emails on my podcast at City Investor Radio. So, it makes no sense. Nobody wins if you're just like, wow, you're an idiot. You don't know what you're talking about. Tell us why. Why am I an idiot? And it's really cool because you have hedge fund guys listening. You have a great, your lineup is just amazing, Michael. It's just amazing. I'm almost jealous of some of the guys you have on your podcast. But when you have people coming in and chiming in and sending you stuff, it's just better for the network. And what we're trying to do here is ultimately get smarter and all of us become millionaires and be right on the right side of these trades. And that happens when we have more people writing in and stuff like that.
I just repeated going out. But I think the thing even though we approach this differently, the commonality is the exit strategy. And I think the fundamental guys that don't have an exit strategy, for the audience out there, those are the guys and gals that you should be scared of. Because if someone's saying to you, here's my thesis, and once again, I'm not talking as a trend following trader, I'm just kind of looking at this from a different perspective, but here's my thesis, here's what I see could happen, here's a bet that I think is worth taking based on my fundamental insights. However, I could be wrong, and here's my 25% stop loss so you don't go broke. That's a whole different ballgame than someone saying it could go to the moon, but there's no stop involved. A whole different ballgame.
It is, and we'll end with this too, Michael. It's such a good point because I've seen so many newsletters. I've been in this newsletter industry for 20 years myself, and almost since I'm born, since my dad was a newsletter writer for 30 years. I've seen so many newsletters come and go. Right now, I'm seeing so many resource newsletters. I don't know if you know what's going on in the resource industry, but some of those stocks down 80, 90%. And I read some of these guys' newsletters, and they're sitting on 80, 90% losses. That's catastrophic, and that's why a lot of newsletters go out of business. If you see any newsletter writer who's been around for 20 years, they've been around for bull and bear markets, no matter who it is, not just me. It means they have good exit strategies when things don't go good.
Yeah. Hey, Frank, it's always good to have you on. And when are you going to be in Asia again? Next year? Or what's the deal, huh?
I think next year, man, because I had such a good time last time I was there with you. But I definitely want to come see you. And probably next year, I think I'm going to plan a trip there.
Sounds good. Let's talk soon again, Frank.
You got it. Thanks, man.
Take care. I love having Frank on my show. He's always great. No edits with Frank. I mean, Frank is on target. Likewise, no edits with Robin. He is smooth as well. Not the greatest sound. Sometimes you just have to deal with it, but great content. I hope you enjoyed this episode with Robin. Let me go ahead and jump in. I want to quickly get to your early days and kind of walk forward, but I thought for the beginning of our conversation, it would be nice to kind of ask you a big picture question. So look, you're a technical guy like me, a trend guy, but from a fundamental perspective, how can a pure fundamentalist, a value guy, how do you even use fundamental analysis in a day and age where interest rates are coerced to some artificially rigged level by the central planners? How do you even use fundamental analysis the way that it was supposedly designed back in the day?
You're absolutely right. You can't use them. What we would call the old normal, where Benjamin Graham taught Warren Buffett, you buy stocks on 7 or 8 times earning and you sell them on 15. That doesn't work because the case PE ratio is 26.5 at the moment. Famous hedge fund managers like Louis Bacon have given most of the money back to his clients because he says these days it's better to know what Angela Merkel or Janet Yellen has for breakfast than anything else, and that's not a way to trade markets. I mean, the old normal as we used to know it has been completely blown out of the water and broken. I think it's actually dead and won't come back again. The world has moved on from what we used to call the old normal. And unfortunately, some of the major premises of the new normal are not yet clearly understood. Some of them are in place, all right, but not enough to do meaningful trading. All we know is we're in some sort of a bubble. Bubbles can become irrational for a lot longer, as Keynes said, than we can remain solvent. But when you know you're in a bubble, and you know that all bubbles eventually end up lower than where they started, this is just too darn risky. So you need to go into risk-averse mode and just preserve what you've got, not do a lot of stupid things, basically.
You know, I find it interesting that sometimes technical guys or trend guys, if they happen to have an opinion about how politics works or how the machine works, people immediately say, well, hold on, that's not relevant to your trading strategy. Well, hold on, we're allowed to have an opinion. But if you put the question to the fundamental guy, which I don't think no one does, how do you use fundamentals in this day and age? And I think you make the case clear. It's impossible.
Yeah, I agree. The nearest I've seen to people is to say, well, we've got analysts who forecast next year's earnings. And if we pay them enough to be bullish, they can get the 26 times earnings down to 16 for you, and that's okay. Mind you, Benjamin Graham would still have sold on 16 because he knows that in practice that's still expensive.
Hey, Robin, why don't we go back in time a little bit? Because I think it's an interesting story, your history. And I think it goes back to, I think your first official Wall Street job would have been 1966.
Yeah, that's correct.
Even before that, you were a mechanical engineer, right?
Yeah, that's correct. I left school not wanting to go to university and went to Lucas, who made things for motor cars. They were quite a big company back in those days up in Birmingham, and I learned how to be a mechanical engineer. And in those days, machine tools were not numerically controlled. They were you literally rigged them with a lot of cams and gear wheels and set them up to run. Make, I don't know, nuts and bolts or whatever it was. And then you measured every thousandth one. So you took a sample and you were tracking the sample to see if and when the tolerances got a little bit wide, you stopped the machine and reset it. And basically, I was doing regression analysis. So years later, when I got into the stock market, I thought, well, this is how I handle streams of data with regression analysis. And that was deemed to be a new breakthrough. I mean, these days, I don't think Mr. Bollinger was born back then, but if he was a little boy. So it was before Bollinger Bands. I was doing regression analysis here in the UK, and that seemed to be a new thing in technical analysis, which is what they came and fetched me and dragged me into the game. And of course, I then read all the other books and enjoyed it.
Hey, listen, I think you've relayed a story that I've seen you talk about a friend introducing you to the idea of a chart. Why don't you talk about maybe connecting that early work, the early thinking as a mechanical engineer, then looking and understanding technical analysis for the first time and starting to think about systems?
After that, I got a degree in economics. And of course, that part of what we read there is Schumpeter's model of economic cycles. So already before I got to the stock market, along with the regression analysis, the idea that economics went in cycles, which is a sort of a system, was in my mind. So then when later I read about cycles in the stock market, I was on that wavelength right from the word go. And I've basically spent my life saying if these cycles are right, and the economists will help forecast where we are on those cycles, then the stock market, which is discounting that, ought to be shifted slightly ahead. And this is what the roadmap, as I called it, would look like. And of course, the basic roadmap shape turns out to be an Elliott wave shape, 5 legs up and 3 legs down. Although I would never have called myself an Elliott wave buff, but I think you can argue from first principles that that sort of shape will be there in the stock market around a normal economic cycle. And of course, Schumpeter has 3 economic cycles, very, very long-term ones, which he called Kondratiev waves, we call secular trends. And then the more powerful 10-year rhythm around that, which we call the jugular wave. And then the more normal, which has now been destroyed, of course, by QE, the 4-year cycle, which used years ago to be a British cycle when we were a superpower. And ever since it's been the American as the superpower, it's been effectively the presidential election cycle. So it has been reliably 4 years, mandated as 4 years. But all of that, around a normal 4-year cycle, you tend to get 3 good years and 1 bad year. But the QE seems to be ironing that one completely out. Even the normal annual seasonality, which is a very reliable cycle, a natural cycle, we've gone more than 3 years without even a 10% setback. So QE seems to have smoothed that right out as well. So what history shows that in earlier periods when the cycles get overridden by some force, like a world war, or in this case QE, the cycle isn't dead. It's just submerged. And later, when the force goes away, the cycle pops straight back up where it always would have been all along. So even though we're currently saying it's being broken, we keep good tabs on where we should be in the cycle, basically.
Robin, let me ask you. So you bring up the idea of Elliott wave and cycles. And I also caught in a presentation of yours, you were talking about listening to Ed Seykota in an MTA event. I've had a chance to spend some time around Ed over the years. But ultimately, when you talk about waves or cycles, if it doesn't work out, you still, from a trend perspective, you're riding that winner, but you still got to have a stop loss. So, you're still at that stop loss mentality, even if the idea of the particular cycle doesn't work out, correct?
You're absolutely right. Absolutely. There's a very good little book, I'm sure you've read it, by Ned Davis, called Making Money or Being Right. In my job, when for years I was at HSBC, if you want to make money, you just follow the trend, and when what I call them the traffic light, when the sell signal comes, the traffic light goes red, you get out. You don't sit there at the traffic lights predicting when it's going to go red. You just follow the trend. And at the moment, the trends are at green. They've been stuck at green for a long time. But my job was to make predictions for people. And of course, when therefore you're trying to be right and make forecasts, that's when you need to fall back to the cycles. And sometimes you have to just say, I'm wrong. Because what I've been using as my cycle mechanism, that theory has been overridden by force majeure.
Yeah. Let me ask you also just about the idea of whipsaws. And again, this is something that Ed Seykota sings about in his song. But that's the idea of a whipsaw when you're a trend trader, you're looking to follow a trend and cut your losses. Those periods, like for example, the last couple of years, you've seen some pretty whippy periods. Now, even if those whippy periods were based on Fed actions, etc., for the trend trader, they're still just whipsaws.
They are still just whipsaws. But in fact, overall, the amount of volatility, because effectively a whipsaw is caused by more volatility than you were expecting on your trend, isn't it, really? But overall, things like the VIX index, all these measures of macro volatility, the Fed, by providing free money, has sort of squashed them right down. So Arian has been writing about this quite a lot, saying that this number that we normally use to measure risk, it's telling you there's no risk in the world. And then you switch on the TV, and there's ISIS, Ebola, there's Ukraine. There's more geopolitical risks staring menace in plain sight than I have been aware of in my entire career. I have to tell you, I am really worried about the geopolitical risks.
Let me get you to keep expanding on that, and we'll come back to the trend thinking, because I know you have a very worldly view. You've got a lot of experience. And I think the primary reason, speaking of experience, the primary reason that we missed each other the first time is I believe you got caught in a hurricane sailing.
I did. I was finishing my circumnavigation, which I've now done. Then at the end of that, I left the boat in Trinidad for a bit, and then I went to fetch the boat from Trinidad back to Europe, which I have now done. The weather was horrendous, so I got stuck in the Azores, which is some little, well, it's where people thought Atlantis was, stuck in the middle of the Atlantic for over a month, waiting for the weather to be decent enough for me to do the final 1,500 miles to Europe.
That's awesome. Hey, so listen, here's where I wanted you to go from. Look, even though we're both talking trends and technical analysis, and ultimately the approach for making money is going to rely on those things, but I think you bring some very worldly perspective. For example, the rise of Asia. I would love for you to take a few moments and talk about China and India and how, I'm currently in Vietnam. So, I can feel it and see it, touch it. Not as much as China, not as much as India, but us in the West, we're not contemplating this at all in the correct way, are we?
No, but we should be. What most people don't realize, they think we in the West are the dominant force. But actually, we've been incredibly brief. For 1,800 of the last 20 centuries, 18 of the last 20 centuries, the two biggest economies were China and India. In fact, when it was Akbar, India was bigger than China. The incredible thing is, as recently as 1820, it was still the case that their economies were bigger. Well, of course, the Industrial Revolution actually began earlier than that, about 1750 in Britain, and Britain, Germany, and America got filthy rich on the back of it. And the West has therefore dominated ever since then. But, we demographically are in decline now. We've gone as far as we're going to go. If you think about that trend, it was all about taking people off the fields, out of the land, urbanizing them, getting them to specialize and into industrialized processes. And the productivity of the whole economy, multiplied hundreds of fold while that was going on. But the West is totally industrialized and urbanized now. All of the food in America is grown by less than 1% of all the people. And the same applies all over the Western world. Whereas the urbanization process in India, only 35% are urbanized at the moment. The number's slightly bigger in China, but they've still got a long, long way to go on the back of that. Also, demographically, there are simply more people in Asia by six multiple than there are in the Western countries. As it happens, the demographics of China are not positive. They've just got an awful lot of people. But when the current generation of workers starts to retire, China will go to having a lot more older people than anyone else. It'll be the first nation to have to cross that borderline. Whereas in India, of course, and the Indian countries, including Pakistan, Bangladesh, etc., the birth rate is still very high, and therefore their demographics are very healthy. And the prediction is China will become the largest economy on the planet not far from the end of this decade. When Jim O'Neill originally wrote the BRIC report, he said by the end of this decade, thinking he was a bit too early. He's since thinking he might be a bit too late. But round about the end of this decade, not just the motor industry, but overall, the Chinese economy will be number one. Probably something like 25 to 30 years later, India will overtake it. And then those two economies will be by far the biggest economy. Because there are 6 times as many Chinese as Americans, eventually, when they've caught up and they're modern, and they could have, their economy could be 5 to 6 times bigger. So, and India will eventually be bigger again, I think. So, to me, the secular trend that is absolutely in place, and nothing short of a global war would stop it, is that those two nations of Asia are on an unstoppable path now, that with all sorts of setbacks as credit bubbles burst, that'll make cycles, but the secular trend is on its way to those two being number one. I don't think anything can stop it. And in fact, that is the norm for this planet. That is the mean to which we are now reverting. It doesn't mean we in the West disappear, of course. When Britain stopped being number one, we don't disappear. And America's not going to disappear. In fact, if you look 25 years into the future, there will be 400 million Americans and the economy will be bigger than it is now. But it will have been overgrown by these other economies.
You know, it's amazing as I'm thinking about you giving this great explanation, a great historical perspective going forward. Ultimately, though, what you've just given is a fundamental perspective. And you would think the fundamental folks out there that want you to believe that they know what's going to happen would be giving the same analysis you give. However, when you go to make your trades, when you go to put your systems together, that information is great. It makes you very knowledgeable of the world. But your systems aren't trading off that knowledge.
No, they're not. No, the one where the market, where the reason why the cycle systems on the Chinese market aren't right is because at the time of the Beijing Olympic Games, that thing had a bubble of such awesome proportions that from there it absolutely had to come down a long way for a long time. Of course, it's now done that, and the PE ratio has shrunk back from whatever it was, 300 of the peak, to a more, well, I think it's about 11 or 12, if you can believe the numbers. So it's perfectly reasonable that in India, of course, that didn't happen. So on my charts, the Indian market is obeying my, what we call old normal rules. And basically, the period when the Indian Sensex index got trapped, 21,000, fell back to 16, rallied to 21 and fell back again. That was the cyclical bear market in a secular uptrend. When it then, on the run-up to the election that brought in Mr. Modi, that in my roadmap was the first new up leg, but in a new cyclical bull market, still in the presence of a secular uptrend, which it doesn't get much better than that. So I'm very bullish at that. And to put numbers on it, I believe that and I'm getting this from a good source like fundamentally Lord Desai here, who for many years was a professor of economics at the London School of Economics, but he understands India brilliantly. He is saying, give Mr. Modi time to get his feet under the desk and get some things organized, like a year. You can start seeing this economy not growing at 5.5%, but growing at 8 to 10% and compounding at that for a long time. So, okay, I'm going for, let's say on average, 8% compound growth going forward. Historically, the PE ratio of this market has fluctuated between 11 when it's really bombed out and 24 when it's really excited, and it's currently 15. Maybe 16 now because it's come up a bit. But, you know, it's got a lot of scope to go, both by the growth in earnings because of the policies that Modi will bring in. He's a real game changer. And because of the amount of the multiple can perfectly easily expand again as it's done historically before. So to me, I see this as a low-risk market. The other good thing is India doesn't really import or export anything much to anybody. It's entirely within its own power, apart from needing to import a bit of oil, entirely within its own power to do the things, to modernize, to stop being corrupt, just to become efficient and grow its own economy. And the monsoons, as long as they carry on, which they seem to be doing, the weather forecast guys say that the monsoon looks pretty stable going forward, India can grow its own food. Whereas, you know, China has long since lost the ability to grow its own food.
That perspective you give, though, let's say, you know, you lay out this cogent perspective. If you're wrong, though, if you're wrong about the politicians, you're still not going to have bet your entire net worth on that. And you're going to be in a position that if it doesn't go the way that you expect, if it doesn't go in one of the scenario expectations that you could imagine, you're still going to cut your losses and get out.
Absolutely. I may even trade some of the more volatile corrections because, for example, I actually own at the moment quite a good position in an exchange-traded fund which tracks the Sensex index. But I'm in at around 16,000. So it's come straight up, partly after the election, on the back of Modi as the magic man who will do everything. Well, it's very overbought, using our technicians' terminology. And at some point, you would expect to see some profit taking because it's come up so far, so fast. There'll also be a period when people were thinking, well, this man's been in office for 6 months, he hasn't done anything yet. I thought the budget was pathetic, sort of thing. And you would expect profit taking to come back. And that may, if it falls, let's say, from 27,000 back to 22, I'm sure I'd quite like to have taken at least the top of my holding, if not more than that, and aiming to buy it back on the dip, because the dip would be well worth trading. So I do intend to manipulate the holding, but basically it's a long-term holding. I'm looking for, 20 bags basically on this one, but I will trade around the core position.
Gotcha. Let me go back in time a little bit and get a little bit bigger picture. Efficient market hypothesis, Malkiel, random walk, Eugene Fama. When did you first kind of know deep in your gut that this foundation, this edifice that almost all of the mutual fund industry is based on, when did you start to feel this doesn't hold water?
Yeah, we firstly, as technicians, we more or less, whether we had evidence or not, we had to argue that it wasn't a random walk. And in words, though, the single thing that you can prove it isn't a random walk is this: in real markets, trends appear more frequently and persist for longer than the laws of chance allow. And I've got a very neat way of displaying that data so that actually a small child can see. What you do is you plot, let's say, 3 markets, the S&P 500, the UK FTSE and the Nikkei, and underneath that, to the same scale, you plot a random walk. Can you tell the odd one out? And basically, when you display the data in the right way, a child can pick the odd one out every time. And then you do the same for all the bonds, all the currencies, all the commodities. And in the real world, none of them look like random walks displayed this way. It's because so-called, put it this way, 6 sigma deviations from the mean can't really occur more than once every few light years. And you can show that in the real markets they appear very frequently indeed. Real markets have these long, fat tails, which, of course, the random walk guys think, wow, that's a fluke that time. But actually, they're so frequent in real markets that that's why they're not a random walk. Trends appear too frequently.
Hey, Robin, at a point in time right now where you have U.S. equity markets at all-time highs.
Yeah.
And the complacency is clearly there. I mean, I'm a trend guy. I can't tell you when it's going to be over, this or that. I don't know. But it sure feels like 2007, 1999. It feels like this type of thing. And I think the interesting thing is that, many people out there, many investors don't really know. They don't really know what to do, and they just trust. But the people they're trusting, seemingly on purpose, I guess, but they leave out the discussion of spikes. And you were just talking about the 1, 2, 3 sigma spike out, 6 even. So, but talk about spikes. I mean, how did we get to the point now in 2014 that people think all spikes are gone?
Well, some of the technical evidence, I think, is showing you this. For example, many of the stocks that got the market up to the high in the first place, Amazon, Tesla, those sorts of things, they peaked and are well off the top. The Russell 2000, which has consistently led the bigger index, it's off for the year as a whole now. Even the S&P 600 is down on the year. And then when you look at the NASDAQ, which is still lower than it was at the peak in the year 2000, 47% of the stocks in NASDAQ are already 20% down from their highs. They're in bear trends. And actually 40% in the S&P 500 are in bear trends. So what's happening is the breadth is getting narrowed down and down and down. And if you look at the stocks that are actually holding up now, they're not the ones that go for growth. They're the most defensive utilities and things like that, clearly showing you that many investors feel trapped in equities because you get nothing in bonds. But but they're trying to buy the least risky thing they can find. They really don't want to be in, and they're slowly backing into fewer and fewer things. And it wouldn't even take much of an event to say, you know what, I just want out of here. The Louis Bacons of this world has already said, I just want out of here. I understand George Soros has got, admittedly, a well-priced but massive put options on the market. Again, he knows he doesn't know the exact timing of the top, but many signs are there that we're building a top for at the absolute minimum a 10% correction. The trouble is, and I agree with this, many people expect that if the markets look like they're coming unraveled, Janet Yellen will step in again and say, forget tapering, how about QE 4, 5, and 6? I mean, what do you want, guys? Because Mr. Draghi in Europe is on the same kick, and Mr. Abe in Japan is more or less on the same kick. So she wouldn't be the only one doing it back then. And so that was what we may get is a seasonal top coming down into the normal, a dip between now and late October. If that looks like being 10%, which it ought to be by normal standards, it very well should be at least 10%. If she comes in and phases that one, says, okay, we did that taper, we can start again, you'll get another new set of, you've got a capitulation, people saying, I give up, we've just got to be in. And I'd rather own a blue chip equity and collect dividends off it than some bloody government bond, which, by all fundamental crisis, ought to be toxic waste in my portfolio. That could then take the bubble to a new high next year. I'm afraid, historically, if it did that, you'd have to predict, and it will then end really badly instead of only fairly badly. To get back to anything resembling the old normal, though, the market would need to fall at least 50%. In which case, the 207 thing was the kindergarten party before the adults had their proper one. It could be, I think it's pretty nasty. And then you add in these, which we can't chart, these geopolitical factors, where the world is quite clearly a much less safe place than it was 5 years ago. I mean, a dramatically less safe place. And yet, none of that's priced in.
I think I want the audience to understand, though, that as you lay out these scenarios, and these are scenarios that could happen. However, if the market keeps bouncing forward and going up, you're going to be there with it.
You are going to be there. To be honest, I have dramatically scaled down my Western market positions. My two big positions, one is the exchange traded fund on India. The other one is I own gold again, and the reason is I know it just at the moment correctly, and the dollar is going up, but I don't read the dollar rise as everybody's frightfully excited about the U.S. stock market. I read the dollar rise as the world is going risk off, and still in the now, the least risky thing you can own is some cash, and of all the cash is currently available, the dollar is still the dollar. Maybe 20 years from now it'll be the renminbi or the rupee, but for now it's the dollar. It's certainly not the euro, is it? So the top currency has to be the dollar, and I put sterling second to it, basically. When you panic into the safest thing you can do, you own those two things. And the fact that they're both pretty strong right now, it shows, to me, it's an indication that the world generally is going risk off. A lot of the big money is going risk off.
Robin, as we wind down, I have one last thing I wanted to bring up with you. And once again, I'm going to get big picture on you and go back in time a little bit. One of the books that I know that you have really loved in your career, Extraordinary Popular Delusions and the Madness of Crowds. This is what a great title. Extraordinary Popular Delusions and the Madness of Crowds. This is not what we see today, what we see 5 years ago or 10 years ago. It's nothing new. These things continually happen. These booms and these busts.
Yeah, absolutely. It's not new. I think that little book, and of course Kindleberg has written another book on the same sort of thing. Various economic professors, actually, Samuelson wrote another one as well. But it's that book is the original one. We're in a form of tulip mania, just as the dot-com thing, which peaked in 2000, was a form of tulip mania. in a way, you know what I think might be our generation's real tulip mania? It's cyber currencies and Bitcoin. At the moment, people are fed up with having their money printed by some banker and devaluing it effectively. And they want something where politicians can't muck about with our money. And all around the world, many people are at least buying trivial items. They might buy a coffee or a meal in a restaurant with Bitcoin or one of the other cyber currencies. You can load it onto your phone. I think the daily turnover of global cyber currencies is already up to about 20 billion a day. But of course, Bitcoin is the single biggest one, which is not big in the scheme of global monies, but coming up from nothing, an unregulated thing. I think this has got the scope to be tulips. They're not completely meaningless or valueless, and they fit in with the global public's feeling that their politicians are screwing them around and letting them down. And this globalization that drove world trade for many years is a kickback nationally against that. We don't want to be globalized. If you want to be Welsh or Scottish, as we've just found out, rather than something bigger. And I mean, the logical conclusion of that is you're more proud of being a Texan than an American or an Alaskan. Do you see what I mean? I mean, logically, it would make just as much sense for Alaska to be independent or Hawaii than Scotland, which is, after all, joined on to England. So, but I think this is a global phenomena, and the Bitcoin thing fits in with this sentiment. And we, as technicians, we're interested in sentiment. I think this could be, cyber currencies could be the bubble, the tulip mania of our generation. And we're well on the way up in it at the moment, nowhere near the down part.
But that also means there's a tremendous amount of money to possibly be made if these Bitcoin trends continue to accelerate. I mean, huge amounts of money.
Huge amounts of money could still be made in this. And it may be, the governments are in a nice, what do they call it, catch-22. On the one hand, if they ignore them, they'll grow like Topsy. On the other hand, if they're going to trade, look, we better regulate this. Well, now you've recognized it, you've made it legitimate. Do you see what I mean? So they're damned if they do and they're damned if they don't. But I think it's a real phenomena. I think it's going to grow phenomenally. It might be worth putting a little bit of money into a few Bitcoins.
Hey, listen, I don't want to keep you here. You've been kind enough to give me some time today, and I'm glad I finally got you back from the your travels. Have you? How much sailing have you done? I mean, you've done around the world. I mean, extensive
I've
sailing.
done the whole way around the world once. I've crossed the Atlantic 8 times now. Once in the record, I held years ago when I was much younger. I held the record with Sir Robin Knox Johnson from New York to England. Basically, I held that record. I go sailing, just locally around the south coast of England almost every weekend. It's my passion. I'm on my 16th yacht now. I regularly buy new yachts.
Hey, now have you done any of those treks solo?
Well, I went halfway around the world with only one other person.
Yeah.
So I regularly sail, in what you might call local waters alone.
Yeah.
But the longer trips, I've always had at least one crew with me, because then you've got to get some sleep, basically.
Yeah. Hey, listen, fascinating stuff. I hope we can talk again in the future. I know you've got a blog. Where's the best place for people to go to check that out?
What happens is I write a newsletter, which I don't sign, because the people that want to know I write it do know. And then after a discrete interval, so that the people that buy the paper newsletter don't feel cheated, I then put that out as a blog. It's called World Investment Strategy. But when you go down, those 3 words will bring up a lot of things on the internet. My one seems to be coming from Investment Research of Cambridge, but I don't actually sign it with my name, if you see what I mean. I'm trying to move entirely electronically for the future. I personally think paper newsletters are 19th century, and we should now be entirely in the blogosphere, really.
Well, people will have to figure out the clues and find you the way that you described if they want more. So,
yeah.
Hey, Robin, listen, I appreciate you taking the time today.
Okay, pleasure. Thank you.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.